Hey, Matt Sitter here, CEO of AFN. What we're fond of saying with AFN is that change is where opportunity happens, and the best way to find opportunity in change is a network that is diverse in experience, expertise, and perspective. We do fireside chats on a regular basis, and what we like to do is be able to bring a bunch of different perspectives to the fore for people to be able to learn from. As I said, that change is where opportunity happens, and there's a lot of noise around change right now. And so being able to find the opportunity on it is sometimes a little bit more difficult. And so we pulled in Rusty and Garry for a conversation around how to think about what's going on with the markets, how to think a little bit about what's going on from a macroeconomic basis. Garry and Rusty, they are partners in their organization called Paraclete Advisors, investment advisory and consulting and tax strategy. So they're thinking a lot about like just how people's individual decisions are going into this. Collectively, they got a lot of investment banking as well as private wealth management experience. So with that, great to see you guys. And Rusty, I always talk about you. You're the guy with the Hall of Fame name.
Yeah,
Um,
yes,
but
it's child abuse, but that's all right.
great to see you all. Rusty, do you want to give us a little bit on what the view of the world is right there, right now, and
Sure.
then we'll move into some questions for you guys.
Yeah, absolutely. And I appreciate the time, Matt, Betsy. It's a real pleasure to be on here and hello to everybody joining. So, our main job is to track public markets and invest for our clients. But many of our clients are also business owners, CEOs, executives. And a lot of the work we do on business cycles, which is basically trying to determine based on a bunch of different data series, where are we in the economic cycle? Because the big bad things, both in the markets and in business, occur during recessions, right? Not manufactured recessions like COVID, even though that, was painful, but more traditional cyclical recessions where some amount of excess builds up in the market and it has to be burned off over a period of time. And that's when markets, get ugly. On average, they go down about 34%. And the recovery lasts a little over 3 years to get from peak to trough back to peak. And so we spend a lot of time trying to determine, where we are in that cycle, because, ultimately, although markets can be driven by sentiment in the short term, they ultimately pendulum back towards fundamentals. And it can definitely take a while for that to happen. People can stay negative for a long time. But what we really try and do is sift through the noise and focus on the signal. So, as the most recent example that everybody's super familiar with is tariff gate, right? Everybody knew tariffs were coming. Trump ran on that policy. I think what surprised the market was the severity of the tariffs out of the gate instead of, I'm going to start, kind of medium and then ramp up the pressure for those who don't negotiate or cut deals. He went right with the sledgehammer. So that got a lot of people nervous, obviously, just because the implications of it are unknown. But you can look to past periods very similar to 2018, where a similar narrative was consensus at the time. And that, if you recall, this was primarily China, not all the entire world, but he started a tariff war with China then, and the talking heads all said imminent recession, it's going to shut down global economy, and the market went down 20% in Q4 of 2018. And then what happened 6 months later is the market recovered all of that drawdown because the data showed we weren't even close to recession. In fact, we were expanding at that time. So I think where we would, advise people today is one, and it's a great quote. It's not very long, but the folly of certainty. All right, this is by Howard Marks in a recent quote. He's co-chair of Oak Tree Capital, very successful investment management firm. And his quote is, "There simply is no place for certainty in fields that are influenced by psychological fluctuations, irrationality, and randomness. Politics and economics are two such fields, and investing is another. No one can predict reliably what the future holds in these fields, but many people overrate their ability and attempt to do so nevertheless. Eschewing certainty can keep you out of trouble. I strongly recommend doing so." And so what that means is, or at least my take on that is, you never have perfect information, right? So, you got to be careful with, kind of echo chamber and groupthink. And, I think a lot of people underestimate what can go right because, a bearish narrative or a negative narrative always sounds smarter, right? People trying to time markets and economies and what have you. So, what we would just say that, some of the data points that I think fueled, the recent recovery, it was a pretty, material snapback in a short period of time. What was obviously the trade deal with China, even though it's more of a pause than a specific trade deal. And more importantly, earnings season was really positive. Companies didn't come out and say, hey, the world's ending. Some industries will pass on tariff-related costs to the consumer, but not all will. And so, ultimately, people are investing in earnings streams. So,
Yeah.
there were some weak guidance from some, but on average, it was positive. So we're cautiously optimistic, but in our no way, shape, or form Pollyannish. Their businesses are going to have to adapt depending on
Yeah.
how this tariff, time works out. But ultimately, I think the U.S. gets better deals than they had. And I think people are underestimating the amount of foreign direct investment and corporate direct investment that's been announced. And people say, oh, that'll take forever. And you say, yeah, it will, but there's also a lot of soft costs that can, really lead to material economic growth, such as if you're going to build a big fab as a semiconductor company, you're going to have to select a site. You're going to have to start to engineer it. You're going to have to get attorneys to structure it. So I think that momentum will be helpful, but there's definitely crosswinds currently. Gary, would you add anything to that?
No, I mean, you said, quite a bit. And I think just to kind of land the plane on this opening salvo is markets are subject to suddenness, economies, not so much. And there's a one-to-one correspondence between the market cycle and the economic cycle. However, markets get volatile. It's the way they are. They can shift on sentiment quite suddenly. Economies are more like an aircraft carrier, right? They don't stop suddenly. They don't shift on a dime, and you can torpedo them, and they don't shift out of sight right away. And so I think there was a lot of, as Rusty mentioned, the tariffs, the negative first quarter GDP print, then the volatility, and that noise caused a reflexive reaction in the market. And, it's more like ready, shoot, aim instead of ready, aim, fire. And the markets just responded the way they do. There's a way things are, markets are volatile. There's a way things work, markets move in cycles. And there's a way things happen, which market volatility comes on suddenly, but recessions just don't appear. And there's no reason to believe that a reasonably healthy economy cannot sustain a quarter or two shock to a supply chain, and not have a credit-induced recession, the likes that we had in the great financial crisis, which I think is kind of in back of most market participants' minds. So that's all that I would add to that, is that there's a lot of noise. You got to look at the signals, and the preconditions of the economy right now are durable enough to sustain a quarter or two supply shock from the uncertainty of what these tariffs might be. So,
And I think like the word uncertainty is like I think, at the core of how a lot of us are thinking about things. If we look at our own personal dashboards, right? So you're saying like, hey, there's always going to be uncertainty out there. It seems like, the indicator has moved significantly to the right in terms of uncertainty,
Sure.
but decisions still have to happen in uncertainty. And so I guess one of the questions that I've got is like, what are you seeing is are people making different decisions right now? Let's say even on like a business basis, we're hearing about delays on investing in infrastructure and IT for companies.
Yeah.
How does that play into how you think about the market and what long-term growth looks like?
Yeah, yeah. Well, I'll kick it off and then Gary jump in. So yeah, I mean, uncertainty leads to paralysis, right? People say, I don't know what to do, so they don't do anything, and that can have a real impact on economic activity. I think different industries are impacted obviously differently by tariffs. It's a very specific, kind of shock to the system. So
Mhm.
for an import export or anything relying upon like China supply is probably more impacted. But we're a global economy, so I think we would encourage, and what we try and do as hard as it can be, because market volatility. I mean, we've been through it a bunch. We do it as our job, and it still rattles us because it can be swift and it can
Yeah.
be violent. But what we would encourage people to do is, one, as much as possible, rely on hard data versus, sentiment and what, the mainstream media or whatever, source of information that you get is, be open-minded to what could be right, go right, not just what could go wrong. And then, like in our portfolios, we don't have concentrated positions. Why? Because you never have perfect information. And so how that relates to a business owner is like, you may not build, two factories, but do you build one?
Yeah,
In
yeah.
order to, so you diversify your risk, because by the time you have certainty, you will have missed
Well,
the
yeah, I mean,
the
there's got to be
boat.
bets that are being made. So when
Yeah.
we I imagine you guys are getting a lot of phone calls right now from people who are thinking about the market. What types of questions are people asking? Because I mean, they've got something in mind. They're like, well, should I be taking this particular action? What are the questions that people are asking you all?
Yeah.
You want me to jump on that one, Russ?
Sure. Sure.
I think the two big ones right now are obviously, hey, is there imminent recession? Are we going to be tipped into recession? And I mean that's the $1 million question, right? And as I said, a few moments ago, recessions just don't happen suddenly. They're actually achieved over a long period of time of excesses. And so kind of the rule of thumb, and obviously these are, when you're talking to a business owner, there's idiosyncratic um, items specific to a business, but in general, the risk of a recession occurring at this moment in time, given the signals of our leading indicators that we look at, it would be the swiftest onset of recession that I have ever seen in my career. And that's primarily because of when you look at not one indicator or even two, but when you look at the aggregation of durable leading indicators that have been prescient in forecasting future recessions, they're just not in a level where a recession can be achieved in the next 6 or 9 months, right? That doesn't mean that we can look out beyond 9 months with perfect clarity. I mean, nobody gets the call from the certainty department that says, okay, things are really certain, go forward. But I think to Rusty's point, recessions are what terminates the market cycle and the economic cycle. And the market cycle terminates about 3 to 4 months before the economic cycle. So to Rusty's point, in 2018, we have a pretty good historical roadmap, and a lot of people realize that history doesn't repeat itself, but it often rhymes. And so when you look at, and maybe Russ, maybe you can show that 2018 chart, because it's a little easier to depict when you're looking at a picture. Picture's worth 1,000 words, but from a recession standpoint, which is the primary question we get, Russ, you get to share your screen.
Yeah, I'll share it.
Go to that 2018 case study.
Yeah.
Go to the not that one. Yeah, that one there. No. The signal and the market one, Russ. Yeah, that one. So this is pretty noisy, but this will give you kind of a depiction of how we illustrate this. So you could see in the fourth quarter of 2018, right, we had an expansion signal, and that these signals, green, yellow, and red, give us an indication of the risk environment going forward. And what you're looking at here is in the fourth quarter of 2018, that was when this, tariff and trade negotiation with China was going on. And you can see above, the market dropped about 20% between September 24th and December 24th. But we were in an expansionary phase. We were in a green phase. And if you look at some of the constituents of the indicators, some were showing caution, some were showing green. But when you looked at what was priced into the market in that environment of an expansionary economic environment, the probability of a recession occurring 3 to 4 months out, when remember I said markets peak 3 to 4 months before the economic cycle, from this Q4 2018 indicator fact set, it would take about 18 months to achieve a recession. And so what we were saying is we've looked at over 100 years worth of market cycles, and we've never found a period where the market peaked more than 6 months before the economic cycle. And so you can see the progression as you go forward 6 months, right? There's some deterioration in the data. A year later, it slipped into a yellow or a cautionary signal. But what you'll see, the market recovered, and not only recovered that 19% drawdown within 6 months, it went on to a all-time high and finished 10% higher right before COVID than it did when the 20% drawdown happened. And we didn't just rely on lollipops and gumdrops of historical market performance. We looked at the leading indicators and said, hey, if it's different this time, and it's different this time are 4 words that have never been successful in investing or making decisions to advance property, plant, and equipment or start a factory or whatever. And we just said it's highly unlikely that the deterioration in these indicators is going to happen at the pace that the market volatility was trying to signal to investors and to business owners. And so right now we are in a very similar, Russ, you want to go up to the signals on where we are today? Yeah. So today we're in an overall expansionary signal, right? And so not everything's perfect, but nothing's ever perfect. But these to the right, you'll see 7 of the last recessionary signals. And in this environment, that's what a recession looks like. And to go from where we are today to get to one of these pre-recessionary windows of vulnerability, you'd have to achieve a lot of deterioration. And so our take is like, yeah, could that happen? It hasn't happened before. It could be different this time. But the economy is an aircraft carrier, more like a tortoise, and the market's more like a cheetah, right? Sentiment can change really, really quickly. And right now, we just tell clients, hey, even though we have this ambiguity, if we had it for a quarter or two, we're probably going to be fine. If it goes out beyond 3 or 4 quarters, then yeah, it could be a recessionary impulse. But the recession question we get a lot, we try to look at the signal and just share what the data is saying to us and then give some historical context.
All right. So part of what I'm hearing is we ought to people are asking you guys about if there's going to be a recession. I think implied in that is like, should I get out of the market or not?
That's
Right.
right.
So
Right.
you're saying,
Yep.
hey, the signal, we need to have more signal here to look for around it. So continue
Yep.
looking for signal on it. Anything that we see, it's going to take another number of months for us to really make a good determination on it. When we're thinking about, we're saying, hey, different industries are being looked at differently. Where are those industries that the opportunity feels like it is unimpacted right now, where, uncertainty in the market seems to be impacting them a little bit less?
Yeah, I mean, a lot of it is domestic oriented businesses, right? Those that, produce and sell either products or services here in the US, and tariffs are not a big deal. If anything, the tariffs are helping a lot of businesses like agriculture and, other small businesses in the market. So, I think it's just business and really region dependent as well.
Okay.
So it's not, it's a mixed bag. This time is going to be, difficult for some, but, what you find is that the private sector, once they know the rules and then they adapt, right? They either
Right.
change supply chains to other geographies or, they downsize. The private sector, I think, at adapting to changes or shocks has shown itself to be very resilient, right, and very creative and resourceful. So back to the previous topic. This is one other data point. Is I think everybody has heard in the past the bond market is the smart money. Equity market is kind of the less intelligent money as far as institutional investing. And you look at high yield spreads. Typically, when you have true economic deterioration or pre-recessionary impulses, high yield credit spreads spike, and it makes sense. The bond investor is saying, "Hey, I need to get paid a lot more for the upcoming risk because I think there'll be a lot of losses, a lot of businesses will go out." And so you're seeing a very kind of sanguine and calm bond market, which, if this had spiked, that would be another, data point to say, hey, there may be some, fundamental deterioration under the covers that maybe we're underestimating.
So, if we're thinking about what are the next signals that you all are looking for, and
Yeah.
we put up that one graph where there was a lot of green on there, maybe one or
Yep.
two reds on it. What's the signal that you guys are looking for next, positive or negative, on saying like, hey, all right, this is an indicator that we're on this, or this is like, hey, I'm
Yeah.
ratcheting up my level of worry just a little bit.
Yeah. If I was trapped on a desert island and I only had one indicator to look at other than the one that Rusty just showed, it's initial claims for unemployment, because employment is a lagging indicator, but initial claims for unemployment is a leading indicator. And so when
Okay.
you look at the 4-week moving average of initial claims for unemployment, that gives you a really deep insight into the labor market, because we're a consumption economy, right? 70% consumption. And if the labor market's durable, and there's no cracks in initial claims for unemployment, along with these other credit indicators and
Okay.
such, I think initial claims for unemployment is a big indicator that we're watching, and it's not rolling over. It's behaving quite nicely, and there was a little hiccup in it in the April data, but when you drill down into the data, it mostly was in New York, where they allow, during spring breaks, they allow teachers to take unemployment, right? And
Mhm.
so when you scraped out that anomaly, initial claims are behaving, quite nicely. They're not in a pre-recessionary window of vulnerability. So initial claims is something that I think is a very, very prescient indicator.
Yeah. Another hot topic would be the 10-year treasury and inflation, right? Obviously, 10-year treasury impacts, the single family housing market, the commercial real estate market. those have largely been dormant for a long time.
Yep.
So, any progress, the 10-year got down close to 4, in the last several months, and now is back up to 450. So, I mean, that's cost of capital. So
Yeah.
businesses, I
Yep.
think, a lot of businesses and consumers are less interest rate sensitive now because, I mean, you look at like only 10% of mortgages nationally are ARM products versus fixed products. So a lot of people locked in those low interest rates.
Yep.
So it's not impacting them. But, obviously, it's restrictive, kind of monetary policy. So, if that stays that high for a while, that could certainly have an
Okay.
impact. And then we're very much watching what would be probably the worst scenario is if we get a material reacceleration in inflation, right?
Okay. Yep.
We don't think that happens in the labor market for a fair amount of reasons. Obviously, we're making progress on gas prices, and people forget AI, which is another hot topic we get, what's the realities of it, and certainly a buzzword now. But technology and AI advancement is hugely deflationary, right? It replaces jobs, robotics, right?
Hmm.
It's
Hmm.
so
Hmm.
from a wages standpoint, we think there that inflation continues. It might moderate or have a counter-cyclical pop for a little bit of time, but we definitely, or we believe that the odds are inflation continues to tick down. And then hopefully, I mean, the Fed will be late. The
Yep.
Fed is not going to get ahead of this, even though we think they should. But we expect, 2 rate cuts this year, 50 basis points, and likely not happening until the fall.
Okay, so I just want to summarize the three things that I heard that you guys are thinking about for signals is that the initial claims for unemployment,
Yep.
10-year treasury, looking at what that rate is moving to, and looking at inflation. Those are like, pretty important signals that if we're watching those, that's going to give us a good indicator where things are going.
Yep. Think
Cool.
so. Yeah. They actually have characterized the initial jobless claims as the canary in the coal mine, right?
Hmm.
Like that is one of the more prescient signals.
All right, so we're saying there's our uncertainty meter is way higher. The
Yep.
perhaps like signals on there's a lot of change going on out there right now. So what that means is there's some opportunity that exists.
Yeah.
What do you guys see as opportunities out there that are not being taken in the way that they could?
Sure.
Um,
You
yeah,
want to
Russ,
start?
you want to go? You want to
Yeah,
go ahead?
yeah, sure. So I think right now, from a market standpoint, we've had a really, pretty violent snapback, which is a good thing, right? It's got sentiment getting better. But that's also rates have, widened back out. So I think there's opportunities in fixed income now that are pretty interesting, and those cyclically sensitive parts of the economy like REITs, like BDCs, private lenders, broker-dealer companies, and some of energy infrastructure, I think is a great place to be right now. A lot of those, businesses have come in and are trading 20 to 25% from their highs with very little fundamental deterioration. If anything, it's continued to be pretty good. So I think it's just important to be discerning. Like I wouldn't buy a REIT index, but I would buy specific REITs, right?
Okay.
Like
Okay.
the exposures are different. Some
Yep.
people have, a lot of coastal office where others have very little office. I mean,
Right.
so a lot of the
Yeah,
time sentiment when it swings you kind of throw the baby out with the bathwater. But if you understand the fundamentals of the underlying companies, then that can help you pick winners, even if it's in a less than positive industry.
yeah. And what I would add on to that, less from a micro like investment specific, is the good news in all this is, cycles are born on pessimism, they grow on skepticism, they mature on optimism and they die on euphoria. And I think it's important to keep in mind we're 2.5 years into a new bull market cycle. And it's a bull market cycle that is predicated around a revolutionary technology, right? And so when you think about how cycles work in those four phases, if the cycle were to end, if it's different this time and we're on the precipice of recession, it means that we've had the shortest optimism and euphoria phase in the history of business cycles, right? And usually those are the longest phases, the optimism phase and the euphoria phase. And so what are some things that I'm seeing that give me an indication that it's not different this time is, one, there's $6 trillion of cash still on the sideline. And that's primarily because, markets born on pessimism, that's 2023. They grow on skepticism, that's 2024, right? And that $6 trillion of cash primarily missed the first two, phases of an entire cycle, right? So a lot of the 23 and 24 returns, that $6 trillion didn't participate. And at the end of a cycle, there's significantly, everybody's all in. The cash is fully invested, right? And then secondly, what I think is good news. So in addition to that, there's another indication that when you have a revolutionary technology, there's a really robust corporate finance cycle. There's companies going public, there's M&A, and we haven't really had any of that yet. So the opportunity is this market cycle's more likely than not, it's not over. We're probably early in the optimism phase, although it doesn't feel like it. And that the opportunity going forward is just be patient. Don't, scared money never makes money, right? And a couple of tidbits from a month ago, about 4 weeks ago, the VIX, the volatility index, spiked above 50, okay? Which meant there was a significant amount of fear in the market. It's back down to 18 now, which is a more normal level. But Rusty and I went back and looked at the 74 instances where the volatility index spiked above 50. Every time that's happened, 12 months later, not only was the market positive 74 out of 74 times, the average return was 35%, right? So we've had an 18% recovery since that, since the volatility index hit 50, right? So there's some runway to go, right? If you believe that we're early optimism phase and that $6 trillion is going to find its way back into the market, and we're probably going to have a similar robust corporate finance cycle, kind of like the last time we had a revolutionary introduction of technology being applied to business. It was in the 90s, right? So, that lasted for 6 or 7 years. It would shock me if this bull market cycle terminated after 2.5 years. It's just not probable. It's just not the way things work.
All right. So what we'll do now is we're going to open it up for questions from the folks that joined us today. So if you got a question, I ask either that you put it in the chat, or if you want to ask it yourself, pop up on video and ask Rusty and Garry directly. So we'll give everyone a moment to collect themselves, and then just pop right up if you got something.
Yeah, you know what? One other tidbit to kind of echo what Garry was saying, but there's only been one other time in history when there's been more than 2 straight years of 20+% returns in the market. And that was in the 90s, even though that first Web 1 or the mid to late 90s. And so it's not our base case, but we could certainly see a scenario where you get another robust year this year, even though on average, a third year of a bull market is more of a digestion year. You get modest double digit, maybe 10, 11% return, but it's much more volatile. But I think there could be upside depending on, because you're hearing a lot of concrete examples about how AI is driving productivity. It's just not a cool technology. It's driving, margin expansion, but it's still early and we'll see.
Yeah. All right. Questions from folks. Let's see. So, Laura put in, she's not on screen, can't come on
Yeah.
screen, but so crypto is something that we hear about. Um, what are some of the thoughts or questions that you guys are getting around that?
On
Yeah,
crypto?
on crypto, yeah.
Yeah. You know what? Crypto kind of reminds me of the late 90s, early 2000s, where, pets.com and, what we definitely believe that's where the market's going and that we're not going to, go back to the gold standard or bartering. But there's going to be a lot of skeletons along the way, in our opinion. So, how we've advised clients, we're not even really supposed to, because it's such a volatile asset class, is if you think you want some exposure to it, one, make sure it's proportionate on your portfolio. Like I personally wouldn't put more than 5% of a portfolio in crypto. It's just so volatile. And if you look at it every day, you're gonna panic and punch out. But think the tide is definitely going to continue to rise. And so, we advise people, hey, if you want some, buy the outright currency or buy like a Coinbase, picks and shovels oriented, somebody who's going to be
Yeah.
involved in the trading of the currencies. And then don't look at it for 5 to 10 years.
So just like, maybe just from a psychological perspective, are people treating this more like an asset or more like a currency in your mind?
I think asset, because very few people buy stuff
Yeah,
with
and I
the
think that's the thing that makes
cryptocurrencies.
it hardest to evaluate, like
Yeah.
where you would make any sort of, if people are treating it like an asset, but nobody's buying anything with it, how do you know like what the value of it is supposed to be?
Yeah. I mean, in the instance of Bitcoin, there's only so many of them, right? So it's exclusive, right? That they're not making any more or whatever. They're about to run out. But think about if the dollar was as volatile as like Ethereum or Bitcoin, you could go get your Starbucks coffee. One day you're like, oh, it's awesome. It's only $3 equivalent. And the next day it's $10 or whatever,
Yeah.
$7. So
Yeah.
it needs to be more stable, I think, in order to get to be a real currency.
Okay. So I think, part of what I'm saying is like, hey, what I'm hearing is really think about the bets that you're making there and don't make massive ones because we don't know exactly where it's going.
Yeah, and it's highly volatile, and the average like kind of retail investor is, and I'm broad brush, but is driven by emotion. So,
Yeah.
if you buy a Bitcoin at 100,000 and it goes to 50, the odds are a large majority of people will punch out at that time when
Yeah.
that's probably
Yeah.
when you should put more in.
Yeah.
Yeah. Okay. Cool. Anything to add there,
One
Garry?
thing I would add to that is a lot of people don't realize but the majority of people that have dabbled in Bitcoin, it's ended in pain and tears and suffering because to Rusty's point, they have this propensity to buy during the momentum. And what tends to happen behaviorally for the retail investor. Now, there's always the savvy traders, right? But most people aren't savvy traders, is they end up buying high and selling low and then repeating that, and they don't really ever make any money. I would look at it as if you have a commodities, kind of a, you know, rainy day fund and you've got some gold and some silver, maybe add some crypto to that, but I wouldn't have it as anything more than a placeholder as a hedge where you would buy gold, right? So if you want to put some crypto or
Mm,
Bitcoin,
yeah.
maybe that's a good way to think about it.
Cool.
Good.
All right. Other questions from folks? George is coming up and he's going to ask it.
Yeah, I'll just go ahead and ask, guys. I can't turn on video; it's not enabled, but I'll just ask it. You mentioned new jobless claims as as a leading indicator for recession. A lot of the people that we deal with, and I'm in the finance industry, we run money here as well, but we're very active in global equity trading for other investment managers, and everyone's on pins and needles waiting for the next earnings season to hit, right? Because we all know that that history doesn't necessarily repeat itself, but we haven't seen tariff increases like this since the 30s, and so we're all just this is a unique situation we're dealing with here, and the market is trying to actively consume it, and that's why you see these volatility spikes because it's very much news driven. But in general, you guys, like, are you outside of jobless claims, like how deep are you going to dive into earnings? Because I think that's going to be very, very telling and be a much stronger leading indicator than over jobless claims. Because I think most corporations, at least the public companies, are going to have an idea of where earnings are headed, and then they'll right size their firms from a staffing perspective accordingly, and then you'll see some of that in the jobless claims. But I just wanted your thoughts on this upcoming earnings announcement at the end of in July.
Obviously Q1 earnings didn't have a lot of impact from or I don't know. Everybody, the market started to decline before April or take a breather. But yeah, Q1 earnings, you would that's looking at history, not forward what's happening. But management teams in general gave solid guidance. So there's definitely people who, guided lower, but the vast majority guided in line or higher. Right.
Yeah, or many are just saying they're not going to give guidance anymore. Right.
There's some of that.
There's some of it, but I don't think is broad based. Like there's definitely going to be, like we said, more companies that are more impacted than others. So what we're looking for too, in addition to jobless claims and all that, is the pause didn't solve the problem. The pause, the administration truly needs, China was good, but we need India, we need South Korea, we need Vietnam, we need, Canada and Mexico. We definitely need clarity, I think, for the next leg higher. If we get that, we need announcements and specifics about what are the new trade deals so people know the rules. But I'm cautiously optimistic on Q2 earnings because a lot of the pause will be most of Q2. So I don't think that impact. Now, if we get to the end of the 90 days and there's still, 80% of the world, we don't know how it's going to go, then, that's not an ominous sign, but a cautionary sign going into Q3.
Yeah,
thanks, guys.
As far as just other indicators, and Russ, you can put it back up or not, but there's a basket of indicators that we look at, and one of them is what's forward guidance on a lot of these calls, and not every company is the same, but people were certainly holding their breath for Meta and Microsoft and some of the bellwethers, Google and all that, and what you saw is the fears over DeepSeek AI, China AI, and how that's going to affect the CapEx cycle. We didn't see any material change in guidance on the CapEx cycle, right? In fact, what we saw was a confirmation that we're still in at least the third or fourth inning of a very robust CapEx cycle when it comes to cloud, AI, and invested in data centers, and there's a 5 or 6x multiplier on a lot of these build outs, and so hey, it's going to be volatile, and what my marker is, I think, and what Rusty's marker is again, I go back to 2 quarters of supply chain shock on a reasonably healthy economy is not going to cause the next great financial crisis. So that would put us at, end of September. So if we're sitting here today or in September in the same, what I would say, the same place as far as some of these trade deals, then I would start to get, a little bit more concerned about the future earnings in 2026. But as we sit here today, in the aggregation of all of these things, it would be premature to punt or punch out on this economic cycle and therefore this market cycle.
Yeah, and related to that, and this will be quick, but just showing you one more chart, and it's super counterintuitive. But if you look at this is a U.S. Economic Policy Uncertainty Index. And so obviously it spiked in 2020 when what's the government going to do? They shut down the global economy. And you see it, if not even higher than in COVID today. And then down here, you look at what are forward returns on the S&P 500 out 6 months and 12 months based on that uncertainty index. I know this is a little kind of convoluted, but it's basically with the higher the uncertainty, the higher the next 6 and 12-month returns. And it makes sense because usually politicians, think about it from like the Trump administration standpoint. They have midterms coming up. And this isn't political. This is just how we assess things is they don't want to lose the midterms. So like if these trade deals drag out and we get a steep slowdown in the economy, it's the economy, stupid. They're going to lose the midterm elections. So, even though there's uncertainty, that's usually a contraindicator. And so, we would suspect that, out of self-preservation, they're going to, cut deals as fast as they can. Even if they're not the best deals, we think on par, they'll be better than what we had.
So we got two more questions that I want to be able to hit. I suspect the first will be a relatively quick answer, and perhaps the second will be a quick answer as well. But the first question is around crypto again. So thinking about if there's any foreign currencies, if there's instability on foreign currencies, or even you hear about some places just getting trapped in inflationary spirals. Do you think that that's going to result in any additional uptake around crypto? And if you guys are like, I don't know, I think that's a reasonable answer on this. But
the odds are probably right. I don't think the trust index for global governments is very high at the moment, and a lot of them are way over levered, right? So yeah, I think people are looking at cryptocurrency as a store of value, as and here in the US, we have to get our house in order. Like we have too much debt, 37 trillion.
Yeah, but I guess the difference here is if people are actually using it for purchases elsewhere, will that result in that? I think that's a really tough question to answer.
Yeah. I think people do pay in Bitcoin for certain things, right? And so I think adoption will only go up.
Yeah. I think my biggest concern about the crypto stuff is so much of it is used for black market and gray market stuff.
Yeah.
So,
right.
All right. And then, so Charles asked about the PE ratios in the S&P 500. And so, we've spent a lot of time talking about well, is this different than before? Well, it is different in terms of the heightened level of PE ratios that are out there. What do you guys think about that? What does it tell us anything about what the world looks like?
Yeah. Well, I'll start, Gary, and you whatever, chime in. First of all, if you separate the Mag 10, let's say the top 10 largest companies in the S&P 500, and then the remaining 490, the remaining 490 are basically at medium PE ratios, close to 16, where it's the Mag 10 are the ones that have much higher PEs, and because on a cap weighted basis, there's such a large portion of the overall market, I think it's close to 33%, then it kind of skews the PE. And what we would say is that the Mag 10 is probably pretty price, at the high end of the valuation spectrum. But what markets or especially analysts historically have done is underestimate their earnings power. On average, it's about 15%. So you look out a year, analysts make their predictions on what Meta's going to make, what Microsoft's going to make, what all these companies are going to make. So, if the E in the PE is 15% higher when you finally get there, then the valuation is not as extreme, right, as you thought at that time. So, I'm not saying leap into those with both feet right now, but I would say valuation, you got to look under the covers a little and,
Okay.
kind of see what's driving it.
Anything to add, Gary?
No, I don't have anything to add to that. I think that's, pretty much covers what I would say.
And
Okay.
well, the last thing I would say is that nothing stops at fair value, right?
Right.
So the PEs in the early 2000s, late 90s were dramatically higher than they are today. And
Yes.
with about half the profitability. So
Yes.
it's like, but you always have to be valuation conscious. There's not a bad stock, there's a bad price.
Awesome. Well, so great conversation. If people want to reach out to you, I'm assuming we can just throw your contact information out there. If you want to just throw it in the chat really quick so that people got it, that's useful. But thanks. The perspective that was gained from this was tremendously valuable. Really appreciate you guys spending the time.
Yeah. And if you want us, you're welcome to distribute that deck we showed. It's kind of like a storyboard.
Cool.
So,
yeah.
And if
Sounds
people
good.
want to reach out to us, that actually has our contact information on it. So maybe that's an easier way.
Okay. Perfect.
Yeah.
Good stuff.
Yeah,
Cool.
that was a lot of fun, Matt. Thank you.
Yeah, I really appreciate it. Thanks to everybody.
All right.